This is my financial disclaimer so I don't get sued. Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. Let's take a look at what we're covering in today's video. And in this video, I'll be going over the datasets, the earnings, and doing a technical analysis over the SPY. Now, this week, the market is closed on Friday as it is Good Friday. So there's that holiday. And so the live streaming will be changed in terms of the hours this week. So generally it'd be Monday, Wednesday, Friday. This Wednesday I will be having a minor surgery, so I will not be here. So this week it's going to be Monday, Tuesday, and Thursday. So that way we will cover all three sessions without missing any gaps. So this week's streams, Monday, Tuesday, and Thursday, around that 9:20-ish a.m. time frame, start to 10:30 plus. Anyway, with that said, let's go ahead and jump straight into the data. Now, for the data sets this week, we really don't have a lot. With Good Friday, having the markets closed on Friday, there really isn't a whole lot of data that's going to influence the market this week. It does show that there is some very important data coming out on Friday. I'm not sure if that's true or not, but regardless, this data will affect next week's trading, not this week. With that said, uh, tomorrow, Monday, March 30th, we have Howell speaking at 10:30 a.m. Not really sure which speech this is. Yeah, it doesn't really say. I'm not really sure what he's talking about too much, but that will be important as, there really isn't a whole lot going on in terms of the data this week, so whatever he says will carry some weight. Now, I know there is some news coming out of the Bank of Japan this week as well. So while I'm not currently showing that on the data sets, there was a Bank of Japan interest rate decision, or I believe there's going to be one very soon, if not any second here. So we'll talk about that in tomorrow's video, assuming I do make one. I do apologize not being able to make videos the last few weeks, but I have been trying my best, along with the streams and everything. Anyway, enough of being off topic. So, Monday, it's mainly Powell. Tuesday, we have, the housing um data that doesn't matter too much. I'm not expecting a whole lot. I don't really anticipate the market to move a whole lot due to that data. Now, we have the Chicago PMI coming out at 9:45 a.m. Now, that is fairly important, but I don't put a whole lot of credence into it right now. Um, that's the producer manager index. Don't really care about that too much right now. CB consumer confidence. Now, this has been at an extremely low level for quite some months. Last month was pretty much the first reading where we had something that was above the basically super recessionary levels that we've been seeing. Now, again, the ECB consumer confidence is a soft data set, so it isn't based off of hard data. It's based off of opinions. So we can see a little bit of swings depending on if the sentiment moving into one month or another is good or not. But this month, the forecast is already expecting it to come in extremely low. Um, I'm expecting it to come in probably much lower than that now that this consumer confidence report will be catching pretty much the entire oil volatility we've been seeing. So this is a very recessionary number. It's been that way for quite a while now. Every time we've seen this data set really start pulling down to this range, we have seen a recession either during that time frame or afterwards. So it's something I definitely keep my eye on quite a bit. Now we have the Jolts job openings coming out at the same time, so 10 a.m. But this is a revision. So for February, I don't really care about it a whole lot. I don't really expect there to be a very significant amount of job openings currently, especially with a lot of the oil volatility going on. That really kind of chokes out a lot of the global economy, and a lot of these data sets overall are going to start coming in weaker over the next few weeks. Even though inflation is expected to tick upward, that upward inflationary pressure is very, very temporary. And this is something you can see in every single oil shock is that inflationary pressure is very temporary, and what it generally leads to is a very, very large deflationary range or, time frame after that. So really, I'm expecting a lot of these data sets to start coming in cooler, and that oil shock to really be kind of the catalyst to cause, deflation in the end. So Tuesday, really not a whole lot going on. CB Consumer Confidence Report, I do think can bring the market down quite a bit. Now, with the data set being cooler and kind of being a bad data set overall, that can actually be a fairly bullish thing for the market. And the reason why is because the market currently is already starting to somewhat price in rate hikes this year. Now, personally, I don't think that's going to happen. I'm still in the camp where we're going to be seeing rate cuts, and I know people might think that's crazy, but again, that applies a lot towards that deflationary side of what we see with oil shocks. So I am expecting rate cuts rather than rate hikes. And with that, this this data set is going to be absolutely massive for the market. Um, this puts a lot of weight into pricing in that rate cut later this year. Okay, so this is the type of data set that will really move the CME FedWatch. So there could be a major bullish push from that. So especially with the job openings very likely coming in cooler as well. A lot of this cool data can create bullish price action, even though it's really not good economic data overall. Now, Wednesday, we have the ADP non-farm employment change for March. Now, that is the monthly data set, so um, that's fairly important. Now, the forecast is already expecting this to be fairly low, only at 42,000. Now, that should pretty much be what one of the single weekly data sets are. So already this is very, very, very low. I expect it to probably be slightly lower than that. That's at 8:15, 8:30. We have the retail sales data, so the retail or the core retail sales, retail control, retail sales. Not too worried about that. We might be seeing a spike in inflationary pressure, but very likely that's going to cause a lot of the consumers to start pulling back. Um, Very likely over the next few months we'll be seeing that type of data. I don't really care about Vice Chair Barr speaking. He never really says anything important. So 9:45 a.m. there is the global manufacturing PMI for March. So that's basically covering the ISM manufacturing data. So the employment change, the PMI, the prices. This is fairly important. I am looking for the non-manufacturing side of it though, which we will not be getting this week. So very likely we will be getting that early next week. So that comes out 9:45 a.m. and 10 a.m. Really, that's the main data set for Wednesday. Now for Thursday, essentially all we have is the jobless claims and the exports and imports. Now at 11:30 a.m. we do have the Atlanta Fed GDP. Now, I don't really care about that too much right now because that has been pulling down very, very, very aggressively. Just to kind of cover this, I actually think this is a quarterly release, but yeah, this is a quarterly release. Or no, this is showing the weekly release. Okay, but anyway, going back to last year. Okay, and this really kind of tells our story. Back last summer, so summer of 2025, and it's not letting me show further currently, but we were all the way back towards this lower 1.9%, if I remember correctly, 2.4%, somewhere around that. Um, we basically pulled down, then we started pulling up again, pulled back down, and then all of a sudden we shot back up towards that 5%. Um, ever since hitting that high 5.4%, we've just been gradually cooling down, cooling down, cooling down, cooling down. Um, Very likely that trend is going to continue with the elevated oil volatility. And yeah, that's really the data sets for this week. Not a whole lot, even though I talked a lot. Um, Really, it's mainly Wednesday because we get um you know, some of the more important data sets. Well, Tuesday with the ECB consumer confidence, but some of that ISM data can hold some weight. But other than that, the data sets this week are really not very major. And very quickly going over the earnings, there's nothing on here. That's the earnings. And going over the Fed CME for this month, um, the market was starting to price in rate hike. Currently this is at 2.6% odds. Very likely that's going to maintain that 1% range. And I do actually expect the other side of this coin to start flipping again, where we start seeing the potential for a rate cut start being priced in again. I don't think the rate cuts will happen yet. I'm definitely in the camp of we're going to be pretty much pausing for the next few months, unless we see something very, very major happen. So, um, again, ever since the conflict in Iran started, the market has been slowly starting to price in a rate hike, but that was, a lot more aggressive. With the initial price in compared to what it is currently. This was all the way up, what, at 12, almost 13%. I actually want to say it was closer to 16% at one point. So you could see how quickly the odds are shifting. Again, with this oil volatility, it could be very weird for a large majority of the market, but it will cause inflation in the very, very, very short term run. But that inflation leads to a very large deflationary spike. Okay. That deflationary spike costs people jobs. It will definitely cause the rates to come down. So even though we're not seeing that just yet, I do expect that um, you know, fall/winter. So we will see. If you're enjoying this, please check out my Patreon. For just $1 a month, you can join our community chat and access our tools like the Unusual Whale Spot and our own personal GEX and DEX market positioning. My $12.99 premium tier gives access to my personal trades, 2 live classes a week, which are on Wednesdays and Sundays, and direct support from myself. The links to join are below, but you can also join through patreon.com/wooksy. Thank you for supporting me to help you build skills for a lifetime. And getting into the SPY technical analysis, as always, let's ensure our daily time frame is turned on and our moving averages and Bollinger Bands. Now, I do have this set up a little differently. As you could see, now we have the price in the top left. We have the time frame here, and it does look a little wonky in terms of the recording. But the reason why I have this is for the stream. So when we are not looking at the daily time frame and looking at the moving averages and Bollinger Bands, I could turn that off, and now we have a large majority of the screen being shown. We can very easily see the symbol we're looking at, the time frame, and quickly go over that. So that is a change that I did make. Now for the videos, I might do something where I have the moving averages and Bollinger Bands at the very top and have the price and the daily or in the time frame underneath it. So let me know in the comments which one you'd prefer to see or if it matters at all. But with that said, going over the moving averages, we did have a very large selling day on Friday. There was the potential that we could see a rejection of that selling and see a, essentially a rejection of the lower Bollinger range. Now we did not see that. And before we even get into the moving averages, I just want to cover that. With the SPY having that selling on Friday, we did secure the day one lower low of, that 633.11 on Friday. With the lower Bollinger mechanics, that does tell us that come Monday, the 30th, we should be expecting a lower low into consolidation upward. Okay. Now we will talk about the rest of that later. I do want to go over the moving averages. With Friday selling very aggressively, again, it pulled all the way down to that 633. The market closed at the 634.09. The 5 mile is currently at the 648.91, so I do expect it to be around that 644.20. It might be less than that, so make sure you mark it down on open is going to be very, very important. The 10 mile has been pulling down fairly aggressively as well. Sorry about that. My daughter ran in here and started laughing. Um, anyway, with that said, the 5 mile on open is going to be very, very crucial to mark down because that level potentially could be anywhere from that 640 range all the way again towards that 644 where I'm expecting it to be. Um, that is basically the closest support we have currently. And just looking on the daily time frame, again, with the 5 mile pulling down, we are below the 200-day moving average. The 10 mile is now below the 200-day moving average. And now we're starting to see the 20-day moving average slowly pulling to this range. Now, currently the 200 mile is at the 657.96. It will be pulling up towards that 660 range. So again, with the 20 mile pulling downward, with the 200 mile pulling upward, we should be seeing that range tested to the upside, which again, and let's see what I have for drawings. Okay, nothing too absurd, so I can put a mark on here, but we should be expecting that push to the upside. Even if it's just for a brief reprieve, um, we should be expecting that bullish push to the upside. Now, when I say bullish, overall, it really isn't bullish. And I want to turn off the moving averages here. And, I didn't really cover the Bollinger levels here, but that's not too important. All we have to understand is that we've been absolutely riding the bottom Bollinger here. Friday, we secured bottom Bollinger day one. Monday, we should expect bottom Bollinger lower low day two. From that day two, expecting a push into the upside. Now, with that said, we have been closing major inverse cups for quite a while now. Following my channel, we've been constantly working on closing these large inverse cups. Now, with those cups closing, we have been looking for these cups to form a handle, okay? And the reason why we want to form that handle, and this might look bullish for the moment because it does pull upward quite a bit, but the goal of this handle is to get bearish liquidity. You want to get cheap puts essentially. So you want to really burn the bulls, and I hate to use that verbiage, but that's really the point of a bear market is to burn the bulls. And how do you do that? You run their puts in the money, and you sell their calls at a high premium. Sorry, I was having a brain fart for a moment. But you sell the calls at a high premium. So how do you get high premium out of calls? Well, you have to push the liquidity back upward, harvest that range, get all these puts for pennies on the dollar, and then you squeeze them out. Okay, run them in the money, have those calls that you sold run out of the money. Um, you pocket all that premium, they run to zero, expire worthless, and you win on both ends. That is, the definition of how a bear market is played. So, with that said, we have been looking for a short-term bottom to this very large inverse cup. At first, we thought that the cup potentially started over here. Potentially, it could have started over here. Now, with where we're at currently, we now have to target our next range, which the bottom of this range is really around the 629 to 627. Okay. With that being some major support areas, we should be anticipating the market to see that lower low, test that area, start building some bullish support, head up to the 5 mile at least. And again, the 5 mile on the daily time frame, I'm anticipating to be around that 644. So within 1 to 2 days movement, that'll be around the 638 to the 642, give or take. Um, which means that from that 5 mile retest, we can then reevaluate if, again, we're going to continue selling down to the lower Bollinger, or if we will truly see that reprieve up to the 20 mile like I'm expecting. Um, Again, we have not had a 20 mile retest in over 21 sessions now. So the daily time frame is definitely telling us that a reprieve is definitely due in here. Now, on the weekly time frame, and I want to go ahead and turn off the drawings here. On the weekly time frame, this is technically week 2 of the lower Bollinger move. So think of this in terms of the daily time frame. But in terms of the daily time frame, you have the day 1, secure the lower Bollinger. Day 2, receive the lower low into the upside consolidation. Well, the upside 5 mile is currently basically right where the 20 mile is on in terms of the daily time frame. So that aligns very well. And last week was the second week of that lower Bollinger move. So on the weekly time frame, this is telling us as well that there is room for that upside reprieve. However, on the monthly time frame, there is this potential of heading back down to the 20 mile. Now, we haven't tested this level, I believe, in roughly 12 months, 13 months. So we still have roughly 6 to 7 months before we absolutely need to test this level again. So am I really in the camp that we're going to head down to the 20 mile on the monthly time frame, which that would be at the 614.72? No, I don't think so. I do think that the daily and weekly time frame are really telling us that we should be starting to see a reprieve in here. So from Monday's lower low, that's really what I'm going to be anticipating is seeing a lot of that upside. Now, I do want to look at the 4 hour time frame. You can go ahead and follow along the hourly, but I just want to look at some structure for a moment. So one thing that I've been really looking at is that I have this red box labeled here, and this is a huge chunk of liquidity. And what I mean is that there has been a ton of contracts written in this range that the market has either bought above or pushed below. Okay. Um, that means there's a lot of room in here to grab that liquidity. So with pushing back up to the upside, we would have the full ability to grab all the contracts out of that range, create the top of this handle if, potentially we are going to continue selling, which I'm 100% in that camp. We're going to be selling for quite a while, for quite many months now. Um, but we really do want to try to find the top to this current cycle. Okay, that's going to be very important for shorting for months and months and months out. Okay, so really looking for this 20 mile range. and it does align with many different time frames. And this liquidity range right here is telling me quite a bit that there is a lot of liquidity right here that the market jumped into, went above, and then crashed through. Now that we're below that level, we're going to, what I'm expecting is basically build back out of it and then crash below it again. So, the whole goal of this week is to see if we can start reclaiming that 20 mile range. Um, however, and this is a big however, we're going to show the USO and the VVIX. Well, the VIX as well. The VIX is super, super, super elevated. Okay. Now, there is this range of elevation within the VIX, and it's kind of within this range. And I know this is just a squiggly line on the daily time frame, but it's basically around this like 31 to 38, where once the VIX hits that range, it starts to cool down. And I want to really show the bear market. Okay, and this is back in 2022 all the way to 2023, where the VIX was trading within that, above $20 range almost the entirety of that time, which lasted for over a year. And what happens is we have a very large volatility spike, and then it holds that level for a few sessions, eases back down, starts pulling back up again, eases back down, pulls back up, eases back down, rinse, repeat. Because that's how, they make their money out of the VIX. That's how they're making their money off of their contracts and hedging the downside of the equities. So I really do expect a lot of the same here. Sorry about that, my daughter came in here again. Anyway, with that said, the VIX is right within that range where with the SPY, with us expecting to see SPY hit that lower low, we should be seeing VIX hitting that, 32, 33 range, maybe even that 35, and then starting to ease from there. That's the expectation anyway. Oil, however, and I do apologize for all the drawings. This is from day trades. However, with oil, and I am going to go to the weekly time frame here. We've pushed well above, um, you know, multiple year levels. Okay. The last time we were at this level was all the way back in 2018. Okay, so almost 10 years ago. Um, gosh, I feel old saying that. 8 years ago. We'll say 8 years ago, so I don't feel so old. Anyway, with that said, um, this 129.92 is a major, major, major resistance range. And even prior, and again, this is the weekly time frame, but even prior to this resistance hitting at the 129, and this is again during the 2017 to 2018, from all that way, it didn't hit that range until 2015. And I know there's some splits and everything in here, so that's why I'm not really accounting for this 172 and whatnot. Um, However, Weeple is not showing the splits or the reverse splits, whatever took place. So, unfortunately, we don't have a track of that. We do know, though, that the Yoso price up to that point, these are correct. Okay. So, with that being correct, this 129 range is a massive, massive, massive resistance. Okay. Um, we're starting to get to the point where we're hitting not there yet, but almost all-time highs of oil, and that's very, very damaging for the US, I shouldn't say US, for the global economy overall. Um, I really do expect oil to slow down slightly, but that does, matter greatly depending on the conflict that's going on. Um, with the conflict going on, Oil can absolutely go up another 30-40%. Now, with that said, okay, and again with the weekly time frame here, we can start to expect once we hit this 129.92, it's extremely likely we're going to. The overnight is currently at 127.65, so all the conditions are kind of there to hit that within next week or two. Um, with closing this cup, we should start to see bearish structure. From that bearish structure, this should start creating the handle to the downside, okay? Because if oil is going to continue remaining bullish over the year, we should be seeing some bullish downside structure to grab all that liquidity to continue heading upward. Okay. So that's the real expectation. And with us being in this 129, 130 range, um, this top is really starting to come in here. Now, again, the conflict can change things. There can be something that can absolutely cause us to see oil prices um, just absolutely skyrocket. However, with what's currently taking place and everything else, I'm not really anticipating that. But, I've been wrong before. Now, with that said, I think I covered everything, but I do want to very quickly look at the HIG. Now, on the HIG on the daily time frame, starting to get to this bottom support range. And this support range doesn't hold a lot of weight. However, I do really expect HIG to start pulling upward very, very soon here. And with that pulling upward, this coincides a lot with that 20 mile upside retest throughout the SPY and tech and everything. From that upside retest, that would create the major head and shoulders. If we don't create that major head and shoulders, then we do have this inverse cup here. Should be expecting a inverse handle. That inverse handle creates again that head and shoulders. So as you can see, a lot of different structures do play into this currently. So we should be expecting that further downside after that slight reprieve. We have been seeing the ADL throughout all these symbols pulling down very, very greatly. So within big, we saw that, you know, potential range of reprieve. Within liquid here, we see this still being a lot further downward. Currently liquid is at this 107.62. This bottom support range is really a lot closer to this 106.85. So that does potentially tell us that we can be seeing much further downside. However, I just want to take a look at the Bollinger Bands here. Um, We have not tested the 5 mile support in quite a while, and we did close this micro inverse cup, so potentially we could be seeing a little bit of reprieve prior to that pull down. So we will be looking at that throughout the week, but that is something to, keep your eyes on. But I'm not seeing massive signals telling us that within the current moment we're going to see some huge leg downward. Um, Again, throughout the SPY, throughout tech and everything, I'm really expecting us to hit that lower low, potentially hit that 127 to 129 range, and start seeing some support to the upside. So we will talk about it more in tomorrow's video and more during the stream and everything. But with that said, thank you for watching. Thank you for supporting the channel and what I do. Um, and with that said, I hope you have a great day, a great week, and hopefully you can join in on some of the streams because I would enjoy trading with you all. So have a good night, everybody. Have a good day, and I will talk to you in the next one. Take care.